On Tuesday, it has been revealed that Berkshire Hathaway is actually investing into Snowflake. Snowflake is one of the biggest startups on the market right now, and it's promised to go public in the next few weeks. In addition to that, they also are willing to purchase $4.04 million of additional shares that will be sold from the original shareholders of that company. Salesforce is also going in for another $250 million, and so this makes very interesting contradiction. When it comes to the Salesforce, this is nothing really new. They have been doing this for quite some time. Yet when it comes to the Berkshire Hathaway, this is completely different from what they have been doing so far. As we probably all know, Berkshire Hathaway and Warren Buffett, the main manager of this fund, is actually a value investor. He never invests into IPOs because, as he says, and I quote, "The sellers decide when to come to the market in most cases. They don't pick a time necessarily that's good for you." What he tries to say here is that most IPOs come out in the top of the bull market. This means that they are basically priced at the maximum to benefit those people who have been seed investors or people who invested from the very beginning. Of course, this is not necessarily a good thing for the common investor who is willing to purchase those IPO shares simply due to the fact that they are most of the time overpriced. So this is why it's so interesting. Why would he ever do that? Now Warren Buffett doesn't necessarily make all of his investments. In fact, some of his investments, such as Amazon, for example, has been done by quote unquote his lieutenants, who are Todd Combs and Ted Wilshler. I think that's how you pronounce it. So basically it's an interesting choice. And so I was very interested what exactly the Berkshire Hathaway saw in this IPO. And so I did a little research. And by little, I mean huge research. And so here we are. Let's actually dive straight in and actually see what exactly is so special about Snowflake and why should you possibly invest in it? Let's go and find out. So let's go ahead and start with the actual business model of the company. This is by far the most interesting part, and so let's dive straight in. So the founding team's insight was that the traditional on-premise data warehouses from Oracle, Teradata, and Netezza were rigid and difficult to use and limited in computation and storage because data warehouses were constrained by the amounts of hardware and physical server space companies actually had. As they served more and more customers, they found out that they are not happy with the current offering and that they are in need of a simpler and faster data storage. At its core, what Snowflake offers is the ability to store vast amounts of data in the cloud without fear of locking yourself into any particular cloud vendor. While all three major cloud players, Amazon Redshift, Microsoft Azure, and Google BigQuery, have their own offerings in the space, Snowflake has the advantage of being the neutral vendor, and that has had great appeal to the customers who are concerned about vendors' lock-ins. Not only that, but they actually use the public cloud space for their own business. This basically means that they use their competitors in order to expand their own business. Their main cloud sourcing is coming from Amazon, and so we can see that how interesting of a case study this business actually is. We can see some of the examples of problems that customers of Snowflake had actually had before going in and starting using Snowflake. For example, we have the Chime. So what they wanted to do was really to understand how they can get more users to engage with the feature to locate fee-free ATMs using the Chime mobile app. However, they had terabytes of customer data across all different sources, from mobile/web traffic data onto their product databases, Google Analytics, iOS, Android, and they wanted to centralize all that data in one place so they can have their analytics team query the data and figure out exactly how users are using their app. However, running analysis on existing legacy data warehouses takes for absolutely ever. Additionally, they also wanted to use vast reporting and visualization tools that legacy cloud simply doesn't provide. Next example is Strava. This is the fitness app. So the analytics team was trying to understand how and why athletes were enjoying Strava and figure out what new features they can build in. In order to do that, they had to spend hours and hours maintaining the cloud data warehouses instead of spending it on actually analyzing the data in order to improve their app. So basically they needed a simpler solution. So simply put, Snowflake allows organizations from growth stage startups to large Fortune 500 companies to centralize all of their analytics data from various SaaS applications, product databases, and data silos into one place. So analysts can write SQL or use Tableau in order to get insights and make better business decisions. There are also some other technical details that are worth mentioning. The first one is the separation of computing and storage. They can use those two features at the same time, something that original providers, such as for example the Amazon, struggle to do. Basically what they need to do is first import the data and then analyze it. What Snowflake can do is actually do those processes at the same time. This basically makes the process a whole lot more convenient and a lot more faster. Second thing is that they offer secure data sharing. Snowflake allows customers to share data tables with others outside of their organization in a secure way. So there are numerous interesting examples from this. One of them is Rakuten Rewards working with their 3,000 merchants to have access to Snowflake so that merchants can see how Rakuten Rewards is helping the merchants with conversion. So this means basically that there's less confusion with the copied files and replication of documents in order to provide to your other customers, and this basically allows the process to be a whole lot easier and faster as well. So as we can see, they have very customer-friendly model, yet they do it even better with how they price their products. Instead of locking down their clients to contracts, they charge them for the processing and for the storage that they actually use. Customers have the option to pay on demand or for the prepaid capacity to get volume discounts. This translates very nicely into the customer retention, as we can see the following graphs. Even though the percentages have come down, this doesn't necessarily mean it's a bad thing. Having almost 150 net dollar retention means that basically they can retain customers at an incredibly good efficiency, and that means that their already existing customers are using their applications more and more as the time goes on, meaning that they don't necessarily need to attract new clients in order to actually expand. Now that looking at the customer base, we can see that as of July 31st, 2020, they had 3,117 customers. That's increasing from 1,547 customers from the year before. As of July 31st, 2020, their customers included 7 of Fortune 10 companies and 146 of Fortune 500 companies. For the fiscal year ended on January 31st, Capital One represented 11% of the revenue. That is a decline from 17% in 2019. They have been successfully shifting to higher per customer revenues. The average revenue per customer is roughly $160,000, which is quite high for any public SaaS company. They claim that the number of customers that give them revenues of more than $1 million is 56, growing from 22 the year prior. This is a 154% year-to-year improvement. They seem to have very expandable model of the business, and so I would expect them to grow those numbers of large customers even more in the future. Now let's actually look at some of the numbers of this company. We don't have a lot of data for the actual growth. There's only 2 years of the data. However, in that period, they have achieved incredible growth. For the fiscal year ended on January 31st, 2019 and 2020, the revenue was 96 million and 264 million, representing a year-over-year growth of 174%. When we compare that to the past 6 months of both this year and the last year, we can see that the revenues was $104 million and $242 million respectively. This represents a year-over-year growth of 133%. When you read the IPO prospectus, we will find that the revenue is recognized upon the use of service provided. When the service has provided, the revenue is recognized at the normal rate for that service. So basically what this means is that the company recognizes earning not when the customer actually pays them, but when the customer actually uses their product. So this can be very difficult to actually judge whether they are actually making revenues more than they should be, because they basically put the revenues something that they wish to have, and then what customers actually pay them is something completely different. This can happen, but once again, this is just a little bit of a risk factor at how they actually recognize their revenues. Their potential for growth is incredible. As already discussed, they're very, very scalable business. They're cloud-driven and better than most competitors when it comes to the pricing and offering that they have. Basically gives them an incredible advantage to the customers and of course to them. Now let's actually look at some gross margins. These are basically margins that do not account for anything else but the actual operations of the business. These are not very large numbers, however they have been growing significantly. These numbers aren't as great compared to other SaaS companies for one simple reason. It's because they use the infrastructures of other companies. Because Snowflake's technology all resides in the cloud, the company has a hefty bill to pay for the infrastructure. It said in its filings that it's committed to spend $1.2 billion between August 2020 and July 2025 on infrastructure services. Most of their business is on Amazon, and this is why the gross margins of this company aren't the best in the sector. Now let's actually look at the most funny thing, which is the profits. As we already discussed, Buffett has pretty much never invested into the company that has no profits, and this company doesn't have any profits. In its fiscal year ending on January 31st, 2019, Snowflake lost $178 million on a net basis. A year later, the figure swelled to $348 million. In the 6 months ending on July 31st, 2019, the company net loss was $177 million, and in the same 2 quarters but this year, it was slightly lower at $171. Now that it can point to falling net losses as its revenues grow and its gross margins actually improve, we can actually see the chart for the break even. And Snowflake operations are burning less cash over time. The pace is actually slowing down. This lowered the company net margin from minus 86% to minus 58%. They have around $886 million in cash equivalents, short-term and long-term investment. This gives them some kind of stability when it comes to the unforeseeable future events, so that's pretty nice there. They don't have many contractual obligations either. This gives them a nice platform to grow without worrying too much about the payments that they have promised to make. Now let's look at one of the most important things in any company, and that is its management. If you look at the filings, they classify as emerging growth company. This gives them the benefit of not adapting right away to the new standards of accounting policy, not revealing as much information about their executive compensation, as well as not needing to have an external accounting firm examine their books. This basically gives them a lot more room to give compensations to their executive management and not really reveal much in their proxy statements. This compensation is a bit sketchy. There's some warrants there as well. So you can read through this all, and if you're trying to actually calculate the per share numbers, remember that there's a lot of stock issuance upon the options here. So if we want to actually find out the exact amount of stocks, we need to actually look at all of this compensation and actually determine the value through there. They have 2 classes of shares as well. So the class A will be sold to the investors, and class B is pretty much almost exclusively given to the investment firms that were basically giving the money from the beginning and the executives. Every share B has 10 voting power, while share A has only 1. So if you buy shares on the stock market, you will pretty much have no saying in what's going on in a company. One last thing to mention about the shares is that the Class A shares, the one that's going to be traded on the stock market, only represent about 10% of the whole cake, if you will. Now, talking a little bit more about the management, some members have been with the company for a significantly short time. That includes Frank Slootman, who is the chairman and chief executive officer, who joined in April 2019, and Michael Scarpelli, who is the chief financial officer, who joined in August 2019. The now CEO of Snowflake has actually been the former CEO of ServiceNow and helped that business scale from 100 million revenues to over $1.4 billion in revenues in his 6 years with the company. That's a very, very impressive track record, and I think that overall the management looks very, very solid. So now let's actually go ahead and look at the market and the competition. First of all, the market. The cloud integration is accelerating. In their filings, they cite the IDC report that says that 49% of data will be stored in public cloud environments by 2025, an increase from approximately 30% today. Also, according to IDC, there will be 175 zettabytes of data by 2025, representing a CAGR of 27% from 33 zettabytes of data in 2018. All the data that the companies have is absolutely essential for how they're going to be performing in the future. If the company cannot actually analyze the data and understand where the customers come from and where they can actually expand into and what they should cut, they cannot perform well in the business. This is why this is such a popular startup, because it offers the businesses basically an all-in-one package. They can not only store the actual information, but they also can process it with quite some ease. So now let's actually look at the direct competition. There's two different services that they offer that we should look in for different competition. First of all, we have the data warehouses. Snowflake really competes with enterprises with deeply entrenched relationships with legacy on-premise data warehouses providers like Oracle, Netezza, and Vertica, with the cloud vendors giants like Amazon Redshift, Azure Synapse, and Google BigQuery. It's actually very interesting that many customers are actually shifting from one of those specific competitors to the Snowflake. This has once again mainly to do with the fact that they basically provide a all-in-one service. Since they do use a lot of third-party infrastructure, there is a little bit of a risk that some of that infrastructure will be locked for them to use. In that case, their business model is not sustainable, but once again, the likelihood of that public cloud space closing down on them is significantly reduced, so I don't think that constitutes a major risk. Another part of their business, and the one that they have been investing in significantly, is business analytics. They have acquired Numeracy back in March 2019, which serves exactly that purpose for them to get into the market of analytics. They seem to do it in order to rely much less on third-party software like Mode, Sigma, Looker, and W to do that. So now let's actually look at the valuations of Snowflake. So Snowflake has raised $1.4 billion to date and consumed about $800 million in capital in order to get $532 million in revenues. This implies that they have 0.57 cash efficiency. This basically means that for every dollar that they have raised, they generate $0.57 in incremental revenue. Now let's look at the Rule 40. This is a very common method of valuing startups. Basically what it does is it sums the revenue growth, the profits growth, and the growth of free cash flow. This basically gives startup companies more flexibility between either going for more revenues or more profits. In either case, if they're above 40%, it's a really good number to indicate that they are actually going to be profitable in the future. They have basically 93% in this category, which is more than double the 40% that this rule implies. So I'd say that they're pretty fine when it comes to how well they're growing. And the last valuation metric that we will use is the enterprising value divided by total revenues. For this company, that seems to be around 50. This is of course considering that the price for all shares will be around $80. That means that the whole package will be worth around $2.7 billion. As we have seen, shares A represent 10% of the total value of the company, and that will basically bring it to $27 billion for the whole company. So by dividing that number by the $532 million in revenue, we can get to that 50 EV to total revenues. So why did exactly Berkshire Hathaway purchase this stock? It seems like a completely different investment from anything that they have done in the past. Well, as we have seen, this company has an incredible moat. So basically this is one of the best moats on the market that you can get for a startup company. And also, if you look at the total value of their investment, it's extremely small. It's not small for us, but it's definitely small for a Berkshire Hathaway, which is a multi-billion-dollar corporation. So this seems to be more of a bet to the future. Even if they overpay for it, they're still going to get some value out of it. A ratio of 50 when it comes to the enterprising value to the revenues is an extremely high number, as we have seen. The company also doesn't produce any profits, and yet once again they are expanding very quickly. They're a very scalable company, and everything indicates that they will be profitable in a few years. So this is probably why they're betting so early on this company. We don't know, once again, what exactly the future for this company will be. They do have to rely extremely on the actual innovation and how well they can actually attract people. And in order to attract new customers, they need to always keep on innovating. This is not something some company like, for example, Microsoft, where they basically, their mode is that no other company can replace their product when it comes to Windows computers. In the case of Snowflake, their biggest advantage is the fact that they provide everything in one. So as we can see, the whole risk relies on the valuation. Due to that steep price, I don't think this is the best investment in the world, but once again, we don't really know whether that growth will continue to happen. They do have the potential to scale, as we have seen previously, so if they do decide to scale at the exact same rate for the next 5 years, this investment is going to look like a bargain at the price of $80 per share. If not, however, then it's going to take a little bit more time in order for it to realize. So overall, I doubt very much that it was the Warren Buffett who made this investment. It seems like it was one of his employees who did the decision, and they basically diversify into a field that doesn't have to do with what Warren Buffett knows the best. Before I leave, I wanted to give a huge shout out to John Ma, who actually provided an incredibly good teardown of the Snowflake S1 and IPO prospectus. You can find it down in the description below if you want to read it for yourself. It's an absolutely great read that summarizes all of the points that I've made and a lot more, so make sure to check that out. So that's pretty much it for the video. I really hope that you enjoyed this video. This was one of the most fun companies to actually analyze. Like with most IPOs, they do make it seem like this company has this huge potential and everything is rosy and everything like that. But it was a very fun journey to actually analyze this company. So if you enjoyed this analysis, make sure to hit the like button, make sure to subscribe for more videos like these. There are a lot more content that I'm planning on making, and there's very interesting companies out there to analyze due to the virus and due to this market instability and this kangaroo market that we are experiencing right now. So if you enjoyed it, once again, please make sure to smash the like button, and I'll see you next one. Bye bye.